You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Okay, so we're going to keep the theme rocking and rolling here about bottom fishing, selling volatility, trying to cherry pick stocks that we would not mind owning. Last week, we looked at not necessarily a trade where we were looking to buy the underlying stock, but we talked about Occidental Petroleum, OXY, one of the Warren Buffett favorites. And on the stock play of the day over on the Ally YouTube channel, we approached it as, let's sell a cash secured put, saying that we wouldn't mind buying the stock at a lower price. On the Options Playbook Radio, we decided that we're just going to sell a put spread, saying that we just think that the stock might just hang where it's at. And guess what? The stock just hung where it was at. We sold last week. The markets were closed, and we sold a 55 strike put with a September 16th expiration and bought a 50 strike put with a September 16th expiration. Now, there's a rhyme and reason to why we use those strike prices, but you'll have to go back and listen to the podcast if you'd like to know a little bit more details. Brought in about a net credit somewhere around 70 cents on the trade. And since that time, the market has gone up. And right now, we're taping Options Playbook Radio. It is Wednesday. The markets are open, and the markets are a little bit down today. But we see OXY last traded at 63.28, down about 25 cents on the day. Like I said, the markets are moving, so these are moving targets. With the short put spread that we sold, or the bull put spread, is now trading at a midpoint of 53 cents. Very good market. Market is 51 by 54, so that's a tight market. The midpoint is at 53. So we'll call it 20 cents. Let's say we are up 20 cents on that trade. Market has gone higher, half a point. And what would we do here? We would just stay the course. We got out till September 16th. If the market came down below or got close to the 15 cents range, I would think about buying it back. It always depends on how close it is to the actual expiration date when it gets there. But I do not mind if I can get, 80% of the premium that I brought in. I'm usually going to want to think about closing 85 and 90. It would be better percent of the premium that you got when you sold a short put spread. But nothing crazy has happened in OXY. Markets have been fairly strong, decent earnings in the retailers. The only people that probably are not happy about the decent earnings in the retailers is the Fed, and the Fed is supposed to be meeting today. We are not to that point yet, so I don't know exactly what the Fed notes will be, but they should be speaking at some point in time today. And the strong retail earnings, well, I guess we had some mixed messages. We had Walmart looking strong, but Walmart had tapered expectations by lowering their forecast the last 2 quarters. So it makes sense that they might they set the bar really low on this earnings this quarter, and guess what? They beat that low bar. Target did not do as well. Home Depot and Lowe's did, and we still have a lot more to come on the retail end. But the biggest thing to take away from it is that these companies still have earnings. The growth isn't that large, but they have earnings. And ideally, if you are truly in a recession, you wouldn't expect retailers, especially on the larger end, to still have expectations of earnings going into the end of the year or next quarter or a year or so out. So that's what the forecasts are saying. So the Fed can't be happy about that, in that they want inflation to be tapered. And right now, demand seems to be fairly strong still. It's switching. It's switching from big ticket items to more daily mainstay type items. But with that said, the consumer is still strong. Okay, so what can we bottom fish for? And I think that's going to be what we're looking. Well, the markets have been strong, but we do have September and October, so it's a little bit of a scary period to be looking to invest in some stocks. So today we're going to talk about Freeport McMoRan. And a lot of people have been asking, should I be buying a lot of the electric car companies? The electric motor vehicles, Tesla, Ford, you can throw in there, GM, all of these companies that are switching focus to electric vehicles. Is now the time? Well, I don't know if now is the time, especially if you look at a company like Tesla that is done very well, but obviously overvalued. The numbers behind Tesla relative to Ford, Tesla just isn't quite as strong fundamentally, but the expectation is obviously that Tesla is going to save the planet. And so because of that, stock has ran up quite a bit. And with that said, what's a way that we could play EVs without actually buying these type of companies? Some that are overvalued, some that are undervalued. But you can make the argument, let's try to find something that may benefit from switching from the gas-powered cars to the electric vehicles. And Freeport McMoRan is just that company. They trade, the stock has been beaten up. They trade a fairly decent implied volatility. Their implied volatility is currently trading at 50% implied vol on the option contracts that we're going to be looking at today. And with that said, we're just going to sell a put, like hoping that in the short term, if we do get a little bit of a downturn in the market, that we can even buy it at a lower price. But right now it's trading at 10 times earnings. And on top of it, it has a 2% dividend yield. So the stock today is at 30.30. It's down $1.10. So still a decent amount to the downside. We're going to go out 23 days. We're going to look at the September 9th expiration. And we're going to sell something fairly close because, as I said, the stock has been beaten up. So I'm trying to sell this with the intention of actually buying the underlying stock. It's a $30 stock. 100 shares would be $3,000 plus. Well, if you have to pay commissions in this day and age, there's not a lot of commissions on stock, but it would be $3,000 plus commission or any fees to put on that trade. And it would be a long-term hold from that point, hoping that just the copper in general, the price of copper is waning a little bit, and you could say that those are some recessionary concerns. Just recently, President Biden signed the Inflation Reduction Act, and that gave tax credits for EV makers and EV vehicles in general. And because of that, that could increase some demand in that area. At least the government is hoping so. So with that said, the demand for copper could increase over the next couple of years. Not saying that it's anytime soon, but why not try to bottom fish in a stock like Freeport McMoRan right now, and how would we do that? Now, with all that said, once again, Options Playbook Radio is just trying to take a stock in a certain position with certain qualities as far as the option pricing is concerned, and think about how can we use options to take a position in that underlying. And selling puts on Freeport McMoRan with a decent implied volatility to try to buy the stock at a lower price at a later date, it just kind of fits the outlook for that underlying stock. Now, you're definitely bottom fishing in the stock. There's no, the chart is not pretty to look at. But with that said, why not? So, very simple trade this week. Freeport McMoRan is trading right now at 30.58. Earnings aren't until October, so we got some time for this to play out. We're going to sell the September 9th 29 strike put. We have 23 days until that expiration. We're getting a decent premium because implied volatilities are fairly high. It is currently trading 85 cents by 92, so we'll call it 87 cents. And the intention would be that we're going to do it on a cash secured basis. So that means we have to have $2,900, the amount that it would take to buy 100 shares at $29. And if the market stays where it's at or goes up, well, we allocated some capital, but we didn't get the opportunity to buy the stock. So in this instance, if I just collected the premium, I would be sad about that because I would like the stock to come down, be able to buy it at that 29 price, and then also be able to keep the premium and then be able to make this a long-term hold. That would be the whole plan with this. And this type of trade, I'd like to say, is options for the stock investor. This is how to use options to enhance your portfolio of stocks. Some people might buy the stock, sell a call, and then sell a put against it to buy the stock at a lower price. So they do all three legs of the trade on stocks in particular that have been beaten up, that are trading at lower multiples that you wouldn't mind holding in the long term. There's a lot of ways that you can frame options around an actual stock position. So that's it. Selling the 29 strike September 9th put option and hoping that stock comes down to that 29 strike and we put the stock. That's trading at a midpoint price of 87 cents. So $87 less commission would be what you would bring in. And we're saying we'd want to do it cash secured, which means you could actually do this in a retirement account if you do have the proper approvals to do so. So that's it for this episode of Options Playbook Radio. If you have any questions you'd like to ask us on the show, please email them to me at theoptionsguy@invest.ally.com. If you'd like to learn more about what we do over here at Ally Invest, please follow me on Twitter. My handle is @BrianOverby. And thanks for listening. Hopefully, we'll see you same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.